Hello, this is J. Mike Perkins. I've been a mortgage professional for almost 30 years, mostly working with first-time homebuyers. And I've seen them make just about every mortgage mistake possible. I can't cover all of them, but what I've done here is select some of the top mistakes that I see on a regular basis that you might not make if you just had some knowledge on how the system worked. And I've put together this video, 20 mortgage mistakes you can avoid. I've divided the mistakes into categories. Initially, I'm going to cover mistakes made up front, before you sign the sales contract. Then employment and income mistakes. Then bank statement mistakes, credit mistakes, and finally, because I am in Texas, which is a community property state, Texas community property mistakes. This video is intended for someone who is trying to obtain a conventional, conforming mortgage, an FHA Federal Housing Administration mortgage, or if eligible, a VA Veterans Administration mortgage for the purpose of buying a home which will be their primary residence. If you're trying to obtain some other type of mortgage, then some of this information may not apply to you. Mortgage guidelines are constantly subject to change. This video is being made in September of 2022. And finally, you need to understand this. The exact answer will depend on the mistake and what loan program you're using, but in general, a given mistake may or may not get your loan application declined, mainly depending upon the strength of these 5 factors. The first one being credit and your credit scores. Then your employment and your income. How stable is it? How likely is it to continue? Then your debt-to-income ratio, which is the proposed house payment, plus the other payments that the lender is going to count, divided by your monthly income and expressed as a percentage. The lower that number is, the better. Then the amount of down payment that you're making. If you put more than the minimum down, that is considered a positive factor. And finally, what the lender calls reserves. And that refers to the amount of savings that you have left over after you close on the home. So it's possible that you could have one application that could make a mistake, but was very, very strong in these 5 factors, and that application may be approved. However, another application that just barely qualified could make the same mistake, and that application could be declined. Mistake number 1, not supplying copies of your income and asset documents to the lender up front at the time of initial pre-qualification pre-approval. If there's some sort of issue with your employment, your income, or your funds to close, the sooner you find that out, the better. This is especially true if you are self-employed, because unless you have a background in mortgage lending, or you have really taken the time to study this subject, I can almost guarantee you that the way that the mortgage company will calculate your self-employment income is different from what you think. If you're a salaried or hourly employee, the lender is going to want to see copies of pay stubs for the last 30-day period and copies of W-2 forms for the last 2 years. If you're self-employed, or if you have income that only shows up on your tax return, like investment income, royalty income, rental property income, then the lender is going to want to see copies of your tax returns for the last 2 years. If you've not filed your tax returns because you owe the IRS money, please understand that in most cases, the lender will accept a payment agreement with the IRS because they'll count that payment in your debt-to-income ratio in most cases. To keep it as low as possible, I suggest the 72-month payment option because you can always pay the IRS off early. Mistake number 2, not making a note of your mortgage credit score. Please understand that the lenders and people in the credit industry use multiple credit scoring models, so you don't have just one credit score. Mortgage lenders are going to calculate your credit score in a very specific way. They'll pull a score from each bureau, but they'll actually use a different credit scoring formula for each one. For your Experian score, they'll use the FICO 2 credit scoring formula. For your TransUnion score, they're going to use the FICO 4 credit scoring model. And for your Equifax score, they will use the FICO 5 credit scoring model. Then, they will select the number that is numerically in the middle, regardless of what bureau it comes from, and that is your mortgage credit score. When you pull a credit report yourself off the internet, you're getting something else. You're either getting a FICO 8 score, typically for all three bureaus, or you might be getting the new credit bureau-owned system, a Vantage 3 score. There is no accurate way for you to convert your FICO 8 score or your Vantage 3 score into a mortgage credit score. This is important because if you're shopping around for a mortgage and you call up a lender and you want a rate quote, they want to know what your mortgage credit score is. If you give them some other credit score from another system and that's different than what your mortgage credit score is, then you're going to be getting a bunch of information which is not correct. Finally, please understand that your mortgage credit score is difficult to obtain. Unless you get it from the lender, the only other place that I know of where you can get it is directly from the FICO company, and then you have to pay for it and sign up for a subscription service. Mistake number 3, not knowing the property tax amount on the home that you want to purchase. Don't assume that all homes in a given area have the same property tax rate. I'm coming to you from Houston, Texas, and in the greater Houston area, property tax rates range anywhere from a low of around 2% to a high of around 4%. If you have a home with a $350,000 tax value, the difference in your monthly payment between a 2% rate and a 4% rate is $583 a month. So please find out what the tax rate is on that home that you want to purchase so you're not surprised later with a payment that's higher than you expected. Mistake number 4, being self-employed without the needed 2-year history of self-employment. And what the lender really wants are copies of tax returns for the last 2 years showing that you are self-employed. Please note that if they don't take taxes out of your paycheck, and if you receive a 1099 form at the end of the year and not a W-2 form, then the mortgage lender is going to consider you to be self-employed. If you leave self-employment and obtain a W-2 job in the same line of work, then in most cases, the lender can count the income from the new W-2 job right away. Mistake number 5 is changing from a salary or hourly job to one where you are paid on commission without the needed 2-year history. If the job has a base salary plus commission, most of the time the lender can count the base salary right away. But to count the commission, they're going to want a 2-year history, and then they are going to do an average. Mistake number 6 is changing from a permanent job to temporary employment without the needed 2-year history. Mistakes 7 and 8 apply to overtime income. If you don't receive overtime, or if you don't need the overtime income to qualify, then these don't apply to you. But if you do, mistake number 7 is when the borrower puts down an amount for their monthly overtime income, which is much higher than the 2-year average monthly number that the lender is going to use. Mistake number 8 is to try to use overtime income that shows a clear pattern of declining. Mistake number 9 applies to bonus income. If you don't receive bonus income or if you don't need it to qualify, then this doesn't apply to you. But if you do, mistake number 9 is to just assume that the lender is going to count your bonus income to qualify. For the lender to count your bonus income, there are 2 main things it wants to see. First of all, the lender wants to see that you have a history of receiving bonuses, something like 3 years or more. And second, the lender wants to believe that that bonus is going to continue in the future. Bonus income that is declining will likely not be used. Any kind of non-recurring one-time bonus is unlikely to be used. If you have a very complicated bonus structure with multiple bonus categories, for the lender to use your bonus, they need to understand it, so you will need to provide an explanation. Mistake number 10 applies to Schedule C self-employed borrowers. And the mistake is believing that the lender will qualify you based on your gross numbers, your gross income, before expenses. Schedule C is the most popular type of self-employment. The main thing with Schedule C is all of the business income is reported on your personal tax return on a Form Schedule C. There is no separate business tax return like there would be when on a partnership or a corporation. The mortgage lender has a very specific way of calculating your income for Schedule C self-employment. I can't cover all of them, but I'm going to give you a typical example of how the mortgage lender might calculate the income. I've got gross income up here of $100,000. I'm assuming that in this case, the borrower received multiple 1099 forms, added them all up, and they came up to the gross income of $100,000. Then you have a bunch of expenses, which total $80,000. You've got net income down here on line 29 before home office deduction, and that's $20,000. Well, what is my best guess as to the number that the lender will actually use? In my opinion, I think the lender would most likely come up with income of $40,000. Now, how did I calculate that? Well, I made a couple of assumptions. To begin with, I'm assuming that the deductible meal expense here on line 24B is counted at 100% of the cost because it's tax year 2021 and you were allowed to do that. And secondly, I am assuming that the $20,000 here for car and truck expenses on line 9 was calculated using the IRS standard mileage rate. Because if that's the case, you can add 1/2 of that back. You can also add back anything that's here on line 12 and 13 for depletion and depreciation. So I believe the income they would use is this. They take the $20,000 net, add back the $10,000 depreciation, add back half of the car or truck expense, which is another $10,000, and come up with a $40,000 number. They're going to do the same thing for tax returns from 2020. Then they're going to add them together, divide it by 24, and come up with the monthly average income number. If the income is declining between tax year 2020 and tax year 2021, that could be a problem. Mistake number 11 applies to borrowers who apply for a type of mortgage that requires the lender to get a copy of their tax return. If that's the case, and you have a Schedule C side business, like some kind of a second job, and that side business loses large amounts of money, the lender is going to deduct those losses off of your W-2 income, and that could potentially drastically reduce the amount of mortgage that you qualify for. Mistake number 12 is depending on any source of income that will end less than 3 years from the date of closing. Mistake number 13 is having too many overdrafts on your bank statements. The next 3 mistakes refer to a condition that I call fund sourcing hell, and that happens when you have enough money to close on deposit at the bank, but the lender says you can't use some portion of that money because they can't verify the source of it. Let me explain how this happens. Let's assume that you're applying for this mortgage on September the 1st and your bank statements end on the 15th of every month. The lender will ask you for copies of your last 2 bank statements, that being the most recent one from July the 16th to August the 15th, and the one before that from June the 16th to July the 15th. Any money that you already have on deposit in the beginning bank balance of bank statement number 1 is considered seasoned, And that's the lender's terminology for meaning that it has been on deposit long enough to where they are unlikely to ask you about the source. Let's assume that you need $20,000 to close on this home. And let's assume the beginning bank balance here on June the 16th is $5,000, and the ending bank balance on August the 15th is $20,000. That is the kind of situation to where the lender is going to scrutinize every single deposit on these two bank statements because these deposits are part of the needed funds to close. Some of these deposits can cause big problems. Mistake number 14 is large cash deposits on bank statement number 1 and bank statement number 2. The lender is never able to source cash deposits. Over the years, I've dealt with a number of people that, for whatever reason, save cash at home. Then they get ready to purchase a home, go and put it in the bank, then it shows up on statement 1 or 2 and it causes a big problem. If you're doing that, you need to deposit the money early, sometime June the 15th or earlier, so it already shows up in the beginning bank balance of statement number 1. Then it will be seasoned and the lender will be unlikely to ask you about the source. Mistake number 15 applies to people that receive paper paychecks. If that's the case, the lender needs to be able to match the deposits that show up on the bank statements with the amount of your paycheck stubs. So please deposit the entire paycheck. If you need to take money out, do a separate withdrawal. Mistake number 16 applies to gift deposits. Now, a gift from a relative is perfectly acceptable on any one of the 3 loan programs I've been discussing, conventional, FHA, and VA. However, if the deposit of the gift funds shows up on bank statement number 1 or bank statement number 2, in that situation, the lender is going to require a copy of the donor's bank statement, the person that gave you the money, so they can source the funds. If the donor will not provide a copy of their bank statement, that creates a problem, and then the lender can say, sorry, you can't use that money. If you think your donor is going to be unwilling to provide their bank statement, then you need to get that gift early, sometime June the 15th or earlier. Then it will already be on deposit at the beginning balance of bank statement number 1. It'll be seasoned, and the lender will be unlikely to ask you about the source. Mistake number 17. Allowing your federal government guaranteed student loans to go into collection. If that happens, you now have a federal government collection against you, and it becomes very difficult to obtain a mortgage. To get out of that and have your loans taken out of collection, you normally have to complete a rehabilitation payment plan through the U.S. Department of Education, and typically it takes 7 to 9 months to complete that. Mistake number 18 is believing that no payment will ever be counted against you for your deferred student loans. The only loan program that won't count a payment against you is VA, and that is only if the student loan is deferred for 1 year or more from the date of closing. Otherwise, some payment will be counted against you in your debt-to-income ratio for your deferred student loans. Mistake number 19 is not understanding Texas community property law. Texas is a so-called community property state, and what that means is if you are considered legally married and you buy a home in Texas, which will be your primary residence, then your spouse will have an ownership interest in that home. It doesn't matter that they are not on the loan, don't live with you now, won't live with you in the home that you're buying, or even if they live in another state or another country. Texas community property law is quite restrictive, and it does not allow the spouse to waive their community property rights. You can still buy that home, but the spouse is going to have to cooperate by signing several of the closing documents. If they can't do that in person, they'll need to sign it in the presence of a notary, which is acceptable to the title company closing the transaction. Mistake number 20, being married, living in a community property state like Texas, obtaining an FHA or VA mortgage, and not realizing with those two loan types, the lender is required to pull a credit report on your non-purchasing spouse and count their payments in your debt-to-income ratio. If that creates a problem, you'll have to obtain a conventional mortgage, which does not require a credit report on the non-purchasing spouse and doesn't count their payments in your debt-to-income ratio. Thank you very much for watching. This is J. Mike Perkins.